Guys, my name is Sahil Singh, and in this video we are going to go through the ICT lecture number 8, right? So this was probably a very long lecture, and probably this lecture is, or this video is just to refresh you all, and I'm going to go through all the important takeaways of that lecture, right? So this was a 4-hour long lecture. The first thing is that if you're having a big wick, suppose that you are having a big wick, then what you have to do is divide that wick into quadrants and see if the price is respecting. Don't look at the wicks, right? Just look at the bodies. If the body is respecting the quadrant, that just indicates that price doesn't want to go there. An algorithm is trying to push the price to another direction. And the next thing is that if the price could not even trade till the C, right? We see the mid area of this wick, if the price cannot even trade till there, that indicates that the price is heavy and it's probably going to go up, right? If you're having a big wick, then divide that wick into parts, okay? And if the price can't even trade to the mid of the wick, that is indicative of how heavy the price is, and it probably want to bang to the other side out, right? Now the next thing is opening range. We have an opening range. We have a 30-minute opening range that is from 9:30 to 10 a.m. New York time, and the pre-market area is from 9 to 9:30. At this moment, you can see that there is an FEG over here, and algorithm is not allowing. You can see that how the wicks are respecting here. So the algorithm is not allowing the price to move till this FEG, and that is the indicative of how heavy the price is, and most probably it's going to go down. You can see that over here. So if it couldn't even trade to the fair value gap, then most probably that indicates how heavy the price is, and most probably it's going to go down to get to the other objective of the market, that is the mid of the wick of the big range. So at this moment the price was not even able to trade till the FEG, right? That indicates the price is very heavy, and probably algorithm wants to reprice down. And where can algorithm reprice it to? It can be any premium area. It can either be order block, it can either be a big wick, and if you have a wick, then you can just divide that wick into two parts, and you can have your partial at the mid of the wick. Okay. The 1 minute candle of the news. So if suppose that you have a big news, right, and the news formed a very big candle, that big candle is having a lot of inefficiencies inside it, and it has a higher probability that the price will, or the algorithm will try to go to that big candle to balance out that whole range. And if you're having a big candle, suppose you're having a big down candle, and if you're having a big up candle, that is a balanced price range. Now the next thing is that if the close and the open is same, then you can draw a horizontal line that just showing that it is the same price there. So this is the concept for the opening range gap. Suppose that the close and the open, that is at the 18, right? The 18, I'm using 24 hours, so 18 New York time. And if the close and the open is same, then you can just draw a horizontal line, and that the price also respect that. Now ICT tells that whenever you are trading, just make sure that you're not relying on just one PD array. You are using a cluster of them. As you can see that over here, ICT has used a lot of them. The first is that horizontal line of this opening range, right? The next is the fair value gap. The next is this big, and the next is the price is trading till the C. The algorithm is not allowing the price to move towards or move further than the CE. So that indicates the price is heavy, and probably it's going to go down. So whenever you are trading, just make sure that you are using cluster of this FEG, right? The same thing is over here. Now let's go to the other side of this page. When the algorithm is in the sell program or sell side delivery, and the institutional order flow entry drill, that's it can't even trade, or it can't even reach the mid of the FEG. It shows how heavy it is. So this was the FEG right over here, and we have a institutional order flow that's bearish. The next thing is that the entry drill is that if you have an FEG and the price can't even trade till the CE or the mid of that FEG, that indicates that the price is heavy and probably it's going to go down. This is a sell side delivery, right? This is a sell side delivery, and this is the sell side liquidity, right? So in this sell side delivery, the price is going to the sell side, or price is going to attack the sell side liquidity. At this moment, this is the change in the state of delivery, and probably it's going to go down. If you can't determine the liquidity that the market is going to engage with you, you are the liquidity there. So ICT is telling a kind of quotation that if you are not able to detect the liquidity, then you are the only liquidity, right? So price delivery continuum theory. So this theory states that suppose that you detected that the price is, or the algorithm is trying to reprice at this in this sell liquidity, right? And if you have missed the move, then algorithm has a bump up, right? And this very thing you can just do a institutional order flow entry drill and can just enter at that moment. If you identify the delivery of the price where the market is going to reach and you'll forget the entry or miss it, the target should be as precise as a tick. Don't get in the trade. Basically, we are using the PDCT to get in sync with the trade if you forget the entry. So if you don't know what exactly is or where the algorithm is trying to go, just don't ever do that. But if you are very sure that algorithm is trying to reprice here, then at every bounce back, we can just use any institutional order flow integral. It can either be an FEG, it can either be a midwick, it can anything, it can be anything, and just get in sync with the trade, right? And if you don't know or if you can't detect the target, you can just use the Fibonacci and you can just allow the price to trade till the equal expansion, or you can either use the Fibonacci and some kind of standard deviation to detect the target. Every time you have an index, then you want to measure them from the highest high and the highest low, because you are going to get details that nobody is going to tell you on every single time frame. But once there is a manual intervention, then there is a little blur out. Wait a little bit, because it's going to do when it's supposed to do it. If you are having a big wick, then ICD tells that always divide that wick into parts, basically quarters, and you will be amazed to see that the price is respecting the wicks, right? So the price respected the CE here. It's going down to attack the sell side liquidity. Now, change in the state of delivery. What does CSD, change in the state of delivery, actually mean? So this was a buy side delivery, right? So in this buy side delivery, if the price trades beyond the opening price of this order block, so this is an order block, right? This is an order block, and if the price trades beyond the order block, and it should be a down, or it should be the very first up candle, right? So this is a buy side delivery, and as the price trade beyond the order block, this is the change in the state of delivery, right? And it should, or it doesn't need to get closed even if the wick is there, right? Even if the wick is going down and it trades beyond the opening price of this order block, that means there is a change in the state of delivery and algorithm is trying to attack the sell side. And the next thing is, or the next important thing is that you should not see the price to trade till the close of this last up candle, right? So there are two things over here to check if there is, if the algorithm is, or if the algorithm has changed the delivery. The algorithm should trade beyond the opening price of the first up candle, and that indicating the algorithm is in the sell side delivery. And to check that if algorithm is really in, the price should not trade back till the close of the last up candle. That is change in the state of delivery, and this reverses that for the down candle, right? So this was the part number 1 of ICT lecture number 8. Let us go to the part number 2. So ICT tells something about the turtle soup. So there are two kinds of turtle soup. For one for the entry for the reversal, and one for the entry for the continuation, right? So if you are having a high, and price trade beyond that, that's a turtle soup for the reversal trade. But suppose that you are in a trade, right? And according to the price delivery continuum theory, you can use any institutional order entry drill to enter into the trade. That word is so hard to pronounce. You can just use anything. You can use a wick, right? If you're having a wick and price trade beyond that wick, that's a turtle soup for the continuation and price wants to move up, right? This is one. This is an FVG plus this is a down wick. As the price trade beyond that, that's a turtle soup for the entry, right? For the continuation. Now there is another PD array. When there is no wick, a new PD array. In this PD array basically, so this was a PD array basically. As you can see that the price is not, wait a minute. So in this PD array basically the first candle is not having the wick, and that is creating a kind of volume imbalance. In this very moment, right, you can see that in this very moment the price is not having a wick, right? So this is kind of a volume imbalance because there is an absence of wick or absence of any selling or buying over here. This can be a major target or major kind of area where algorithm can reprice to. You can use this as an entry drill, or you can use it as a price level continuum theory to get in sync with the trend, right? And this is why the price doesn't even reach till the FEG, and if the price can't even reach till the FEG or any discounted PRA, that indicates the price is very heavy and it wants to move up. That is just the converging of wick. That's easy thing. You can see that in this wick the price is trading till the CE of this wick, plus the price is also trading with the CE of this wick. So in this very big wick, the ICD just used the Fibonacci to get the mid, to get the CE of this wick, and ICD used the same logic over here, and CE is converging. That indicates that algorithm doesn't even want to reprice there, and probably the price is more heavy and it is going to go down. Right. So in this very trade, your stop loss should be at the CE of this FEG, or if you are having, or if you want to get like a bit above stop loss, so you can just use this wick as your stop loss. So your stop loss, there is no need to have your stop loss right at this swing high. You can even have your stop loss at this mid of this FEG or at here. Okay, in here. What does immediate rebalance means? Immediate rebalance means, suppose that you are having 3 FPGs, right? So let me just get a pen here if I can. I will show you. Alright, I'm not getting it. So the immediate rebalance is something like this. If you are having a first candle and a third candle, and the first, suppose that the first candle wick is right till here, and if the third candle goes and touches the wick of the first candle, that's an immediate rebalance, and you want to see a huge aggressive price moving downwards, right? That's the immediate rebalance. Algorithm is controlling the price. There is a drill that ICT gave us. Just get the first, or just if you're having 2 wicks, just get the longer wick and see the price is only trading till the quarters of that wick. So it's traded till the mid AKT, till the CE. It can even trade this here, 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 or here. That indicates that the algorithm is controlling the price. And this is the end of this ICT lecture number 8. And I have a lots of notes right over here, and I will try to make a video and discuss everything that I learned in all of these notes, right? So this was it in this video. I hope you enjoy it. Till then, take care. I'll see you.